Hi there, I'm Daniel Lader, founder of Lader CPA and Associates, and welcome back to our ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. This week's presentation and topic is going to be on reasonable compensation for an S-Corporation owner. So one of the biggest tax advantages that an S-Corp is that not all of its profit is hit with that high self-employment tax. But there is an important rule. If the owner works in the business, the owner usually needs a salary first. Now, the IRS says that an S-Corporation must pay a reasonable compensation to a shareholder employee before making non-wage distributions. And the IRS can also reclassify distributions as wages if the salary was too low. So the goal of today's topic is we are going to try and understand what a reasonable compensation means and understand why this matters for tax savings and audit risk, and learn a simple way to think about setting the owner pay. Now, why does this matter? Well, many owners hear that an S-Corporation can save them a lot on self-employment taxes, and that's true, but only when the payroll is done correctly. Now, if the owner takes too little or no salary while doing most of the work in the business, that creates the risk. A bad setup can lead to back payroll taxes, penalties, and interest if the IRS reclassifies distributions as wages. Now, what does a reasonable compensation mean? It means the owner should be paid a wage that makes sense for the work they are actually doing. Now, the IRS does not give a fixed, easy formula or a perfect number for a reasonable compensation. It's based on facts and circumstances. And in plain English, that means what would it cost to pay someone to do that job? Now, there are a number of factors that the IRS and the courts will look at. Let me just tell you a few of them. The training and experience required for the job, the duties and responsibilities that are being done, the time and effort devoted into the business, what similar businesses are paying for similar work, if you have payments to non-owner employees, any compensation agreements, the timing of bonuses and other payments, and probably most importantly, the distribution or draws history for the owner. All of those things play a role in helping the IRS determine if a reasonable salary is reasonable or not. Now, there's the easy way to explain it. Start with the role that the owner is doing in the business. Then, look at how much of the company's income is coming from the owner's personal work. Now, if the business is making money mainly because of the owner's services, that points towards a strong, high wage requirement. But if the business makes more money from staff, systems, equipment, or assets, that may support a lower owner wage relative to profit. Now, just to give you a quick, easy example, picture this: a solo therapist who owns an S-Corporation and personally sees clients all week should usually expect a meaningful W-2 salary. Why? Because the revenue is mainly being produced by that owner's direct services. On the other hand, if the owner mainly manages the practice and the team of clinicians, and clinicians are producing most of the revenue, the facts may support a different and lower pay level for the owner. Now, the answer depends on the real work being done, not just what saves the most in taxes. Now, the basic tax strategy for an S-Corporation is not to pay yourself as little as possible. The strategy is to pay yourself a reasonable wage, then take anything extra out of the profits as a distribution. Remember, an S-Corporation can pay you two ways: the wage or salary you set up, and then owner distributions or draws. And that is what the benefit of an S-Corporation comes in. That's where it creates tax benefits. The payroll is subject to the payroll taxes, but the distributions are not subject to those payroll taxes. So the salary It has to be considered first, and it has to be defensible. So there's an easy framework I want you to think about. First, as far as what the owner is doing, list all of the hats that the owner is wearing. Are they a clinician, director, manager, admin, marketing person? All of those hats. Estimate how much time is being spent by the owner in each of those roles. Compare that work to local industry pay rates or other jobs. Document what you have as you pick your final salary based on those things. And each year, revisit and update things. The level of work the owner is doing changes from year to year. The amount that's being paid for similar work changes from year to year also. So we got to keep that live and current. Now there's some good documentation you should keep on hand, just in case it is questioned and audited by the IRS. First, keep a job description of the owner and what they do. Note the duties they're performing. Keep an estimate of the time they're spending on these duties. Have a reasonable comparison to other compensations for similar work. Something as simple as Indeed, job listings, or Glassdoor, something like that. And keep a record of how that pay was set. Now, many of you will have an EHR system that does most of that for you. Just remember those records are stored in there with the number of sessions you've done compared with the total sessions done for your practice. Now there's a couple common mistakes I want you to avoid. Do not take owner distribution and have no payroll. That is the immediate big red flag the IRS is looking for. That's what they're trying to find so that they can audit you and get all those penalties and interest by changing your distributions into payroll again. Also, do not use a salary that is clearly too low. Do not put it at $10,000 unless there's really good basis for that. But otherwise, do not put it at $10,000 a year. Another mistake is not revisiting the salary regularly as the profits of the business grow. That can change, especially with a rapidly growing business or from year to year, as we said earlier. Also, another mistake, do not guess any numbers without support. Another mistake, don't forget that retirement plan contributions are based on W-2 compensation, not your S-Corp distributions. So if you find a reasonable salary and you set it as low as you can, that's good. That'll save you taxes. But remember, that limits how much you can contribute to a retirement plan. You're playing those two factors against each other, so keep that in mind. Now, why does this matter for retirement planning? Remember, those S-Corp distributions don't count as income for retirement plan contributions. Only W-2 wages count, your salary, your reasonable compensation. So again, setting it too low can limit what you can contribute to your retirement account through the business. A couple practical tips to remember. Don't just chase that lowest possible salary. That might be a good strategy. It might limit what you're wanting to do as well. So keep in mind, there's a range, not just automatically go for the lowest. Set a number that you can explain and justify with confidence. Update that number when the duties change or the hours change or the profits change. Keep your written support handy and make sure you have it available even before there's ever a question from the IRS. Remember, the goal here is not just tax savings, but tax savings that can hold up against an audit. A couple closing thoughts for you. S-corporation planning works best when the owner's salary is reasonable, supportable, and documented. A good tax strategy is not about being aggressive for 1 year. It's about building a system that saves you money and still stands up under review. I'd like to leave you with a critical question. If the IRS were to ask you today why your S-corporation salary is reasonable, what proof would you have to show them? Now, next week, we are going to be talking about self-employed health insurance deductions, especially for the S-corporation owners. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves. And let us help you to do just that. I'll see you next time. Bye.